And so I would just say, don't let the capital gains tax hold you back from the things that you want to be doing, could be doing, should be doing, right? Get started now, build a plan, connect with us. We're here to help you out.
Hey, everybody. Welcome back to another episode of the Richer Geek Podcast. We have a fan favorite returning, Brett Swarts. He's considered one of the most well-rounded capital gains tax deferral experts, informative speakers on the West Coast. His audience are challenged to lean into multiple capital gains tax deferral strategies. That's really important now, so you don't have to pay any of the high taxes that are coming out of DC. Welcome back, Brett. How you doing?
Hey, Michael, better than I deserve. Good to be here again. Thanks for having me.
Yeah, absolutely. The weather's kind of crazy. We're in January 2024 as we record this, and it's kind of crazy all over the place. Hopefully it's warming up a little bit where we're at, but hopefully. So, let's talk a little bit about what are you seeing in 2024 with tax deferrals, anything coming up, anything that we should know, any changes coming on the horizon, talk to us a little bit.
As far as capital gains tax deferral, nothing that we see that's changing. That we do have to be aware of in 2026. We're going to have the lowering of the estate tax exemptions. They're going to drop to about 12 million. So you can do some preparation for that prior to 2026. So 2024, just 2 years before that, that's an important thing to think about. But as far as capital gains tax, it's still high. It's probably only going to go higher if it goes higher. And that's taxes are rising. I think that's so the problem becomes more and more as the election's going to be big. Obviously it's a big thing, which way the government goes with that. But nothing that's like pressing to change, like tax deferral. Like the 1031 exchange was challenged a couple of years back, but that's kind of quiet right now. But
yeah,
you never know when they bring that back up to try to take it away. But so it all seems pretty, I guess, quiet on the capital gains tax front.
yeah, that's good. Yeah, I do remember a couple of years ago, they're like, wait a minute, there are people that are deferring their taxes. No, we want to tax it, get rid of the tax deferral. But, kind of the big thing with tax deferrals, and I see it also, is as I defer and defer and defer, now all of a sudden my assets are getting larger and larger. And then the amount that I have to defer, it gets harder and harder to be able to place that. It's like, what am I going to do with it? It was easy when it was 50,000, 100,000, maybe $1 million to tax defer. Now, when you get into $3, $4, $5 million on a sale, talk to us a little bit about some of our options that are out there. What can I see? Deferred sales trusts, statutory trusts, some of the different things that are available for when we have, I can't place it, because we only have so many days. And if you get too in a rush, I might make a bad mistake getting into something because I have to place it.
Yeah, I think you got to really have a tax flow mindset that's coupled with your cash flow mindset, right? Most of us focus on cash flow, what we're making on the return on investment, 5 to 7, 7 to 10, or an IRR over a period of time. But when you add the tax flow element, it really changes the game. And part of that is looking at your ROE, your return on equity, as compared to if you were to sell and move that equity somewhere else. But what the roadblock people are seeing right now is interest rates are obviously gone higher this past year, and you're looking at cap rates that are still maybe not that much higher than they were a year ago, at least not in proportion to how much interest rates have increased. And so you have what's called a negative arbitrage that's going on, where I might borrow at 7%, but my cap rate may only be 5, coupled with not a lot of value add opportunities out there, because a lot of those have been gobbled up the last 10 years and people had fixed and flipped those. So you come into kind of a stalemate, and where sellers are not willing to sell because they have capital gains taxes, and B, they don't want to overpay for properties because interest rates have gone higher. And so what we really want to focus on is, how do you connect tax flow, cash flow, and what we call debt flow? We took debt for granted for many years because it was so low. Well, now it's much higher. And so this is part of the challenge. You can have a great deal that's operating and it's fantastic on collections. It's actually pretty good on the NOI, but the debt has gone sour or it's gone south or really it's gone north, it's gone higher, which means which means your NOI, minus the debt service, right? Your cash flow is much lower. And so as an example of this, we have a client or potential client. I just talked to him today. He's got a rental house about $2.7 million range in the Bay Area of California, Silicon Valley. Well, he's renting the property for $5,500. His debt is 1.5 million and his debt service is about 7,000 per month. He actually has good financing in the high threes, but he's been negative cash flow for a while now. And the biggest thing is he's been cash out refining, which are cash, tax free when you do that. But then it gets recaptured. It can if you have debt over basis. And so we got to really look at this with what I call like a 3D lens, right? You got to say, what am I trying to do? Am I trying to get more cash flow? Yeah, that's what he's trying to do. Am I trying to get out of debt? Absolutely. Does he want to retire? He does. He's actually in his 70s and he wants to fully retire. And that's why the 1031 exchange just isn't his friend, right? It's not our friend when we have to overpay in a short period of time in properties that we don't necessarily want to be in. And you want that diversification, that liquidity, and that debt freedom. So you got to use a different tool. And so it's not always the hammer of the 1031. We use the deferred sales trust. And in this scenario, we can, get his debt paid off, get him diversified, get him liquid, and get him passive. Now, should he want to be active? He can be again with the trust, but that's really the key. It's like what solution is going to solve the problem you're trying to solve, and that's why we love the deferred sales trust here at Capital Gains Tax Solutions because it solves the fundamental freedom and flexibility motivation for most of the America's high net worth individuals. And
Mm-hmm.
you've got to have flexibility and you've got to have freedom. And if you can do that the deferred sales trust can, then you can really trade in any market. And that's the beauty. The deferred sales trust, high or low, any asset type of any kind, we can buy and sell. So yeah, we believe the DST is perfect for a time like this.
Yeah. So what do you think about, there are some people out there say, oh, deferred sales trust is, especially the IRS doesn't like it. Um, it's listed as just kind of almost a scheme. So what do you, with the distractors out there, what do you talked about? Like, they go on the internet, they see the pros, the cons. The IRS doesn't like it, of course, because you're deferring things. What do you say about, with the detractors out there that say, I don't know how this deferred sale trust really works or if it's legit. Um, is it something that, people are just going to fee me to death? Talk about some of the cons out there that we're seeing on the internet.
Yeah, we'll start with the legality, right? So the neat part of the deferred sales trust is it's batting 1,000, meaning it's never had a single change on any of the audits, thousands of closes, billions and billions and billions of deal of volume over the years. And most of the audits have actually been in California. So it's
Mm-hmm.
all no change, no findings. It's literally perfect. And it's very rare to find. I like to say it's the most vetted tax deferral strategy your CPA has never heard of. It's worked every time. It's never not worked. But there are those out there that try to couple it with other strategies that are actually on the watch list that have don't work. Like the monetized installment sales is a great example. It's never worked unless maybe you were a farmer, but people have used it, and that's been on the IRS watch list. And so we do have those in the 1031 exchange community who would like to couple us with those because we are a competitor to the 1031 exchange. Unlike the 1031 exchange, we work for any asset of any kind, cryptocurrency, business sales, high-end primary homes, also investment real estate, whereas the 1031 only works for investment real estate. So there are those that write things on the internet, but it's like the drive-by media. They're
Mm-hmm.
going 100 miles an hour and then trying to see what sticks to the wall to get people to click and just to do a 1031. But we just continue to close deals. Like we just had a $13 million deal in San Diego. We just did another two deals for a client out of Colorado, 11 million, 46 million in Texas, New York, New Jersey, Florida, $6 million business sale, Menlo Park, San Francisco. We've deals all over the country, at Los Angeles, Arizona, and we just keep closing deals. So I think that's the first thing to know, that there are those that don't know about the trust or don't want to know about the trust. And a lot of commercial real estate brokers want to keep you in the 1031 exchange because that's the way they get paid. A lot of QI companies want to keep the money where they can get paid. By the way, I'm a California real estate broker myself, sold over about $500 million in commercial real estate, mostly multifamily properties, and done Delaware Statutory Trust and the Deferred Sales Trust. And so you have to kind of follow where that's at, but you also can't blame them. And they just don't know about it, right? They don't know, and they're not comfortable because they don't understand how to execute it. And that's where we have our competitive advantage, where we do know how to execute it, and we keep doing that. On top of that, well, we provide lifetime audit defense, which is really important because you want to be able to sleep well at night knowing that if the IRS does come knocking, that you can defend it. And we have defended against the IRS about 24 times over the years, and we've never had a change. And so I'd also push back on the IRS doesn't like it. The IRS may have opinions on different things, but they're not the ones who make the laws, right? They just kind of enforce the collection of the tax. And so I think sometimes they get misconstrued as because they're collecting the tax, they don't like the 1031 or they don't like IRAs or 401ks. They actually, we would say they do, and it's in their best interest to like it because it actually spurs economic growth. With the Deferred Sales Trust, you have sellers that are selling the assets. Like we did an $8 million deal in Palo Alto. Well, that's a new property tax for the state of California, right? That's a commission for that sales professional, right? That's a mortgage origination fee for that mortgage, originator. And essentially there's taxes on all of that. And so who wins the most is actually the IRS. Now, the person who is selling, he gets to defer his tax, but guess where the money goes? The money goes into business ventures, stock market, real estate, which produces more jobs, more tax revenue, which the IRS wins again, right? And so it's actually, if you pull back the layer a little bit more and think about it, the reason the 1031 exchanges, the IRAs, the 401ks, the deferred sales trust are around is actually the government's best interest because it spurs economic growth. Otherwise, what would you do? You wouldn't sell the asset, which means no more property tax, no new property taxes, no commissions to pay tax on. You might even run the property into the ground, which means you lose the value there, you lose the tax revenue. You might even lose the renters to have housing, right? Because if it's a rental property, people that can't take care of properties or don't want to anymore will just let it go to waste, and now there's less housing. And so these are all the reasons why these strategies have remained intact, even though people out there may not want you to know about it, but this is why we started our mission, to tell everyone about it, educate everyone on it, and literally just keep closing the deals. And when you close the deals, that usually speaks louder than any of the detractors out there, Mike.
Sure. Yeah. That's completely correct. And the main difference, and we'll get into what exactly a deferred sales trust is, with the 1031, I'm swapping it. It's got to be a like exchange, but in a deferred trust, sales trust, you actually have to sell it, correct? And it is an actual sell. And the key difference is, it's like, it's kind of the method of payment is going into this thing, you sell it. So for those people, talk a little bit about that, but then what exactly is the process? You have the third party, kind of like the 1031. Do you have that, except, instead of them controlling everything, is it different? Is it the same? What are the steps if I have an asset and I want to do a deferred sales trust? What is the steps to do it?
Yeah, first of all, let's define the deferred sales trust and then let's talk about the process, right? So the deferred sales trust is just an installment sale with the trust. Okay. And we would all know, or if you don't know what an installment sale is, it's basically where the seller can carry back paper, meaning he's becoming the bank or the lender to the buyer. So for example, if Mike has a hotel for $10 million, he owns it free and clear, and it's a zero basis, which means he has a big tax bill if he were to sell it right now. He could finance Joe down the street. Joe could put a $2 million down payment. He could finance the other $8 million. Mike only pays tax on the 2, defers the other $8 million. And as Joe pays Mike back over time, Mike will pay taxes slowly. It's known as an installment sale, IRC 453. Well, that's what the deferred sales trust is. The difference is we're going to ask Joe to come with the full 10 million. I'm going to say, Joe, we're not going to finance you. You go get cash or go get a bank loan, however you're going to get the money, come with the money, but you're going to cooperate with this trust. And the trust is going to buy the asset from Mike for 10 million and ask Mike to carry a 100% financing. and then immediately sell it to the ultimate buyer. And what happens is it is a sale to a trust, right? Like you said, and the trust sells it to the ultimate buyer. And so there's really three parties in the transaction. And when the smoke clears, buyer has title the same way he would have normally. And Mike has a promissory note for 10 million, typically written at 6, 7, 8, 9% return on the money. And that's the interest rate that's on it. And we have to go make the money, right? Then we have to go invest it. But that's the process of this. And so yes, the capital gains tax solutions is the trustee. We're sort of like the qualified intermediary. We're sort of like a 401k company a little bit, right? But these individual trusts only do business with the seller and their spouse if they're married, and they can pass on the promissory note is what you now own, Mike, right? You don't own the trust if you own it to be taxable. But the neat part about it is now this trust can be invested into different things that you would like to invest in. And it can be diversified, and there's no timing restriction to have to put it into something in a 45-day window or 180-day close. And so that becomes the beauty of the deferred sales trust. You put time on your side.
Mm-hmm.
So we just released the best 1031 exit plan, where we provide the 1031 service with the backup plan, because you might be stuck in, well, Brett, I actually do like real estate and I think I can find a deal right now. Well, great. We love that too. When you can find a 1031 deal, go buy it. And you can go for the 1031 and the best 1031 exit plan. And in case it fails, we have the deferred sales trust to save the day. And that's the cool. It's like that parachute when you're flying 100 miles an hour for that 45-day 180 sprint, and you can jump out and just, float down safely on the deferred sales trust versus just crashing the plane and paying the, 20, 30, 40, 50% in tax. And so that's the best 1031 exit plan. We will help you with that. So we're not against 1031s. We're just against the outcome of poor purchases with the 1031 when you overpay, whereas the deferred sales trust can be that safe harbor that gives you a chance to wait and see when the market makes sense for you to buy.
Can you combine the two?
Absolutely. In fact, we do that all the time. So we do that all the time because sometimes you might find a perfect deal. So we did a deal with a client named Craig out of Texas. He sold a ranch for about 7 million. And he was looking at a place to buy in Oklahoma and another place to buy in South Carolina. Well, combined, he bought both of those, but combined, they only equaled about 5 million. So he had an extra 2 million of boot. And so we used that extra 2 million instead of paying tax on that, it went to the deferred sales trust. And so that's the same thing. So in the best 1031 exit plan, we can combine multiple strategies. And sometimes it's a Delaware statutory trust that we might use to replace debt over basis. Think of it like in a Rubik's Cube. Everyone's situation is a little bit different. And that's what's unique about us is we're going to take this cube and we're going to say, Mike, what are you trying to solve for? What are you trying to do? Well, I want all blue on one side, all yellow and all red on this one side. Okay, great. Let's move that around to align. And at times it might take a 1031 regular 1031 exchange, a Delaware statutory trust 1031, and then a deferred sales trust, which is the one that most people want to get to ultimately because of the flexibility for timing, diversification with the wealth. And ultimately, a lot of other entrepreneurial clients, they just want their powder to be dry, ready to pounce on the deal when it makes sense. Yeah.
Yeah. And that's what all of us want, because we don't want to pay taxes or, more than what we feel we should. But, in the end, they get it. Now, you just threw in another term in there. Let's talk a little bit about the Delaware statutory trust. Now, what is that and how does that differ?
So a Delaware statutory trust is just another part of the family of 1031 exchange. Okay. So think of it like a commercial real estate syndication where you're a passive investor buying an interest in a trust that owns 1, 2, 3, 5 assets. Right, where it's direct ownership. It's kind of like a tenant in common, okay? But you're 1031ing your equity into a partial interest of a trust of which you're a small minority owner. You give up all control, all liquidity, all diversification, okay? Some of the downsides too, there's huge fees, okay? And typically 7 to 10 year holds. Now, some of the upsides are they're beautiful properties, proven operators, typically really good locations, good tenants. But the returns are maybe around 5%, a lot of them, right? And you're basically just, I call it sleepy mailbox money. You're just, nothing wrong with that if that's all you want. But know that your returns are gonna be pretty low. You're gonna be a lot of fees involved, and you're buying in the same market. You're sold high, and maybe you're buying higher with a poor interest rate. And so again, it gets to that 1031 blockbuster but they do solve mortgage over basis. They're also which is great. You can get a lot of debt over basis offset with the deals that we do with the Delaware Statutory Trust, which is typically the only one we really use for that. And then number two, they do maintain the stepped up basis, which is great. Stepped up basis is fantastic, right? Unless you have a state death tax, but now you're in trouble because you're locked into that deal. And so you can have to just look at what you're trying to solve for and figure that out. The last thing that it's good about is non-recourse debt, meaning the debt is typically not in your name, it's in the company's name. And these are very big tenants that are in place, or big apartment complexes, which are pretty safe. So just keep that in mind. But the worst thing about it is not being liquid, not being diversified, not having any control. And a lot of our clients just say, no, thank you. I'll only use it to the extent that I need to replace debt over basis. I want the majority into the deferred sales trust.
Yeah. And again, everybody, we have Brett Swarts on with us. Let's talk about this book that you came out with last year. I heard it's doing really well.
Yeah, absolutely. It's called Building a Capital Gains Tax Exit Plan. It hit #1 bestseller on Amazon for the real estate and wealth categories. And it's a phenomenal book with some really great, smart minds. In fact, they say to get in rooms with people that are smarter than you. Well, that's what I did with the book, Mike. So I got in the book with people that were smarter than me, people like Kevin Harrington from Shark Tank, a billionaire, and he talks about how to make a mentor to millions and really give back in his story of entrepreneurship. People like Don Winter, who's the head of DLP Capital, who's built a phenomenal multifamily housing really movement with what he's built there. It's pretty incredible. People like Joe Fairless, Michael Blanc, Neil Bawa, people like Tyler McBoom, who's Tony Robbins CPA, and just some really smart people that talk about building wealth, building wealth in a smart, efficient way, building businesses. And so it is building a capital gains tax exit plan, because ultimately, when everything happens with building wealth, there's going to be an exit. And so you got to be thinking of a mindset of, how do I build a plan along with building my business or my real estate or my wealth? And they go hand in hand, because you don't want to get caught with a huge tax. And so I tell my story of how I came about the 1031 exchanges, my real estate career, my entrepreneur journey, and of course the deferred sales trust. And I give away as many secrets as I can give away so people can be equipped with the strategy, overcome the false beliefs of it's too good to be true. My CPA would have known about it. Do I have to give them all control? How does it work with the trustee? What are the fees? How do I make the DST an investment and not an expense? And I try to bring it all together with some of the best minds that have vetted the deferred sales trust. And so that you can start to say, wow, this actually does work. Man, this is incredible. People like Brian Burke, great example. Brian with Praxis Capital said, Brett, I've been in the business 30 years. He's one of the most respected guys in commercial real estate syndication and funds. And he goes, Brett, I didn't see anyone pull this off. You're the first one, and they're one of our top strategic alliances. And so when you start to get those types of people that are running with you, you'd say, look, give it a shot. Give us an opportunity to talk to you about how it works, why it's legal, and how it can unlock the freedoms that you're looking for. And that's where the DST, we also believe it's just not a tax deferral strategy. It's a wealth building machine. Once you have the team in place to execute the business plan on how we can eliminate the estate tax, give you a new depreciation schedule, but a lot of times just giving you that confidence to know that if the 1031 fails, hey, I've got a backup plan, right? I don't have to settle for a deal that otherwise I would never have bought if it wasn't for the tax and the 1031 exchange forcing me into it.
Yeah, and I wish I'd known about this earlier in my career when I was doing a lot of multifamily, because it was the anxiety and the stress of saying, I've got to find something in the heat of the market. And the only thing I can find is properties that people don't want, or else they'd already been taken, right? So I'm being kind of forced to do something, and then like, okay, now what am I going to do? Am I going to hold it? How expensive is it going to be to turn this thing around, when I could have, a company like yours just say, hey, leave it with us? Is there a time period that you have to hold it within your company before I pull it back out and use it? What is that kind of the process, in case 6 months from now it's like, oh, something just came up and I'd like to buy it?
Yeah, So there's no time frame, right? It's totally flexible, right? So you don't have to force into anything. So that's the beauty of the deferred sales trust. You get time as your friend. Time is no longer your enemy. And time horizon is the number one key and a foundational ingredient for any investment, right? You got to look at that. Let me bring this to life for you, though, right? I have a
Mhm.
client, Warren and Catherine, and they owned a $2.5 million apartment complex in Sacramento, California. They had actually done a multiple 1031 exchanges, and they bought from a Manhattan Beach duplex. They moved it up to the 15 units. And so for them, their NOI was about $120,000. So you do the math, $120,000 on 2.5 million. So it's not a bad ROE, but it's not actually great. And they're also looking at rent control. They're looking at, fires that are challenging California. Insurance costs have just skyrocketed. Frankly, they've made their, let's say multiple millions, and they're ready to travel more with their kids. In fact, they had two twin daughters a little bit later in life, and they're going, Brett, I'd really just like to spend more time with the family and not have to deal with traffic driving back and forth to the property. And they had property management too, and it's a 100% occupied property, and it's a beautiful property, right, in the foothills of Sacramento. But long story short, we looked at the deferred sales trust and we ran the numbers, and I said, Warren and Catherine, I go, we can increase your NOI, net operating income, if you think of it like this, net of cost, net of fees, to $190,000 from 120. How would you like a 60% increase in cash on cash return? None of the toilets, trash, and liability, the ability to go back into your own deal if and when you want to, and to not have to deal with the rent control and the nonsense that California is putting you through. And they go, where do I sign up? Right. And so we closed the deal, and I asked Warren, I said, Warren, what's the biggest thing? He goes, Brett, I didn't realize how much of a burden this thing was. I didn't realize how much time and energy it was on me. And more than that, how much it was taking away from my family, my time with my twin daughters. And he goes, just the toilets, trash, the termites,
Mhm.
he goes, those are the three T's that were just really frustrating. And I go, you know what, Warren, you know what it sounds like? It sounds like you traded the three T's for the two T's that matter the most.
Mhm.
And I said, your twin daughters. And he goes, Brett, that's exactly right. I traded the right T's for the right T's, and I increased my cash flow. I mean, this is absolutely amazing. He loves it, and we love the transformation it can be for his family. And that's ultimately what we want to do is we exist to unlock capital gains, to multiply wealth and freedom, right? And ultimately impact. And the impact for him is his family, the
Mhm.
legacy he could spend with his daughters and still increase his cash flow and have all of the things that ultimately what people want, which they buy real estate or invest into it to get freedom. But
Mhm.
when those assets, like another client of ours, Gary Lester, he had $10 million of mobile home parks, 5 different parks. He's going, Brett, these parks are taking over. I started out as a side thing to just to do for retirement. We started to knock it out of the park, but he goes, it's just so much. He goes, you're telling me I can increase my cash flow, get out of the parks and the management. I could still get back in if I want to, and I'll answer your question now. And so for Gary, we've been in passive real estate deals, liquid investments, waiting for the market to shift. Same thing with Warren and Catherine. And we've been being selective on certain opportunities. And part of what we move into is like a multifamily lending fund that pays about 10%. The neat part about that is it's about 30-day liquid, right? So Mike, I can put in a million today, start making about 10% per year, but any 30-day period, I can raise my hand and get a portion of it out or all of it out and still have made about 10% on the money, which is pretty awesome. And so you look at that, you don't have to be tied to the stock market. You can also put it into T-bills, make 5%. But then when you want to, you can partner with the trust. And this is the best part about all of this. In fact, I wouldn't have started the company without this concept that you can start an LLC, Mike, and
Mhm.
that LLC can joint venture partner with the trust, where the trust puts up all of the money and you are the managing member of that. This is all tax deferred. So you haven't paid $1 in tax yet, right? You only pay taxes you receive it personally, but this isn't a personal distribution. This is a joint venture partnership into what? Another hotel business or a hotel development or a multifamily deal or a new business venture. And that's the beauty of this, that now you are with the trust as a joint venture silent partner running the deal that you probably would be running anyways, right? But you would already had to pay tax to get it, but now you're using the government's money along with your money to fund it all tax deferred. And so that's the concept there, the joint venture LLC partnership. I've got a whole YouTube channel that talks about this in extensive detail. But you go to capitalgainstaxsolution.com too to learn more.
And it's kind of like all of our dreams sometimes. You're a GP for so long and you're just like dreaming. It's like, please, can I just take some of my money and and I'm getting older and say, can I just be the LP in something and get a good return? And I mean, it does kind of sound like a dream, um, just because the headaches. It's just, my God. Um, some of our assets are home runs, and some of them are like going. After COVID, just COVID kind of changed everything with some of these asset classes and
It's like
locations.
Proverbs, right?
Yeah.
There's a time to heal. There's a time to life, and the D really gives you the opportunity to harvest and to be passive and to be whatever it is that you're wanting to do in this season of life without having to force yourself not to be the other one. Because some of our clients too, they have the kids that are between the ages of 10 and 18, right? And now it's like, well, I want to maximize my summers and my time and my energy coaching my kids, and I don't have to deal with my properties, my business right now. But once they're 18 and they're off and gone, well, I probably want to get back in the game again and really build a wealth and do the things. And so the DST gives you that chance to hit
Yeah.
pause for those crucial years with your kids and your family without having to, be forced to not have to be able to do those things in the future. Right.
Hmm.
So the DST can go in and out of liquid and illiquid investments. You can set different time horizons for different amounts of the money. And you're, hopefully feeling great and diversified because all your eggs are in one basket. You're not having to have debt in your name. I mean, we call them the 12 freedoms of the DST, right? There's partnership freedom, 1031 freedom, estate tax freedom. There's, um, there's the diversification freedom, liquidity freedom, and you start adding these things up, and that's the neat part about the DST. It can literally do all of them, but usually it's 2 to 3 that really are the hot buttons for our clients. And when it clicks, they go, oh, it solves that, and that will transform my wealth plan, my life, and my energy, because this product is that versatile and powerful. Which is also why it's not as well known because it's not easy to execute, right? We think it's simple, but it's not easy, right? In the sense that it does take a team, it
Hmm.
does take expertise, it does take, getting to know us, like us, trust us, understand our clients, and, who our clients are. But we have all of that, and we work on a conditional basis. Yeah, we're in a fight though. It's a fight for the 84 trillion of wealth that's transferring from the baby boomers into the next generation in the next 20 years. And the question becomes, will it be in the hands of the people with flexible strategies like this, or be in the hands of the government, who's probably going to waste away pretty quickly? So we also see our higher purpose is to make an impact for the freedom of America. And it's like the reverse Tea Party, right?
Hmm.
In the beginning, 240 plus years ago, it was fighting for representation on taxation. Now we've built the most amount of wealth in the history of the planet that we know of out of any other country. And now it's transferring, and it's during that transfer that's most vulnerable, right, to tax. And so to be on the front lines to help to solve some of this 84 trillion can make all the difference. And what does that mean? Well, we want to invest into multifamily housing to end the housing crisis, right? We want to help to create more jobs with the money by creating more business ventures. But the money that's stuck in what's called, capital gains tax jail, we're stuck in 1031 jail that just has to buy investment property. That's where it becomes so rigid, right? But if you can develop, right, with the capital multifamily property, if you can start new companies, if you can fund, ventures that are going to change the fabric of America, that's the key, right? And this is 84 trillion that is, going to be taxed. And so solving that and becoming that bridge between the two is the key to us for the the fight for freedom.
Yeah. I mean, it's 100%. I absolutely agree with that. Before we wrap up, is there anything that I've missed? Anything else that you'd like to talk to our listeners about?
I just would say don't put off today what what you're feeling like is the next best move for you and your family, right? And don't trade what's unique to you for something someone else can do. COVID has taught us one thing in particular. I know my family is time is short on this earth, and in fact 85% of the time that we have with our kids is before they're 18. And for what that meant for us is we moved out of California to Florida, and we established residency in St. Augustine, Florida. And we're traveling. We're trying to spend 1,000 days in 100 unique locations with our kids before they're 18. We homeschool our kids too, which is pretty flexible.
Mm-hmm.
We do jujitsu and soccer. We travel to different places, and I'll be taking my daughter to Costa Rica coming up here in a week for a one-on-one time that we could have together, making memories. And so I would just say, don't let the capital gains tax hold you back from the things that you want to be doing, could be doing, should be doing, right? Get started now, build a plan, connect with us. We're here to help you out, and we would love the opportunity to serve anybody. Here's some minimum requirements real fast. $1 million net proceeds and $1 million gain. So it's got to be a big enough transaction to qualify, but it literally works for any asset of any kind. It could be crypto, business, real estate, it could be stock, public or private. So it's any asset of any kind, as long as it's $1 million net proceeds and $1 million gain. If it's big enough, you qualify. We also only get paid as it closes, but you need to set this up prior to closing, right? Unless you're doing the best 1031 exit plan, and then we could save your 1031, but get with this early so that you have the option. Okay. If you wait too long, and too long means you've closed escrow and the money's in your account, or B, the buyer has removed all contingencies, it's too late, it's over. Unless you use the best 1031 plan because you have investment real estate, then you can use the DST as a backup plan. So yeah, go to capitalgainstaxsolutions.com. And the last thing is we have expert tax secrets. If you're a business professional, commercial real estate operator, syndicator, financial advisor, CPA, and you're saying, Brett, I really resonate with everything you're saying, and I want to learn more, and I want to become more of an expert in this field, then we have our coaching program and our mastermind to help you, get hands-on coaching, right, and consultation to help you build out a way to roll this out to your clients, right? So that's experttaxsecrets.com for that.
And, thank you so much, Brett, for coming on, and congratulations on getting out of California, moving to beautiful Florida. That's a beautiful state. We love Florida, and we appreciate you coming on. We hope you have a wonderful day. Everybody, again, Brett Swarts, really good meat. Look it up, go on his website, grab his book on Amazon, and don't make the mistakes that I've done in rushing exchanges and just the stress, de-stress it a little bit. Get on his website, take his classes. Brett, it's been wonderful. Thank you so much for coming on the Richer Geek Podcast.
I appreciate you. Thank you so much for having me.
Yep.